Happy noon Central Time to everyone, wherever, whatever time it is in your time zone. We're excited to share with you updates from our various funds and for Black Swan today. Lots of exciting things going. It's been an
Yeah,
incredible Q1 2025. Hard to believe that's already in the rearview mirror.
I know. I know. It feels like, everyone that knows me well knows that January 1st is like my favorite day of the year. I'm all about new years, new beginnings, everything. And it feels like that was just a few days ago. I can't believe that Q1 is already done and very excited about our performance update for Q1 of 2025. It's really a continuation of late 2024 of talking about the portfolio maturing and the acquisitions that we had in 21, 22, 23 really stabilizing after going through their renovation period and how we're so protected because of our fixed rate debt from a lot of the turmoil that's happening in the broader real estate industry. So lots of good updates to share today. We always do try to make these noon webinars a little bit faster than our evening webinars because we appreciate that you might be joining us from lunch or in the clinic or something like that. So let's jump right in.
We're mixing up our format just a little bit. We're putting like fund four, then fund three, then fund two, then fund one. And we're trying to put sort of, I'm going to say the most interesting updates first. So in case we do run long or something like that, we'll have, the rent growth numbers per property and stuff like that later in our time together today.
Absolutely. And as always, if you have any questions, please pop those into chat. We do our best to read those in real time and answer them as we go along. And then anything that kind of doesn't fit in the slides, we do make sure we cover all of the questions at the very end. So that's one of the big benefits of coming live is that you get the opportunity to ask your questions live. And with that, let's go ahead and share our screen and get started here. All right, here we are. It's our Q1 2025 update. Our usual disclaimer on our updates is that what we are sharing is actual data from the portfolio performance. Past performance is not necessarily indicative of future performance. We will at times make forward-looking statements, and as always, those are projections. There's no guarantees that those will happen. Real estate investing does have risk, including the potential for loss of capital. Anytime you're making an investment decision, you should consult with your professionals, your attorneys, CPAs, financial advisors, whoever is important to you when you're making an investment decision.
And a little bit about us. If this is your first time joining us today, I just had a call with an investor that I encouraged to join our update call today. So, my name is Nick Stageberg. This is my wife and business partner Elaine Stageberg. We've been married for 14 years now.
Mm-hmm.
It's pretty awesome, and have five kids, 9 and under. We just spent this last week in Disney. It's like the triathlon of parenting. 10 miles a day with a double stroller in 90-degree Orlando heat.
Not one double stroller,
Two double
two
strollers.
double
Yeah,
strollers.
getting nine people through all the lines and stuff like that. We also do a little bit of real estate. We've got over 400 million in assets under management. So we've got a pretty good sized portfolio. It's very vertically integrated. So we own our property management company. We do in-house lawn, snow, maintenance, construction, helps us control cost and drive quality and outcomes to our tenants and our investors. I've raised a little bit of capital, over $85 million, closing on that $100 million mark, I think. We're at this year. So that'll be a fun milestone to hit. I'm a licensed real estate agent with Keller Williams. That's where we're standing right now, is in a Keller Williams brokerage office. And we've done a little bit of real estate sales. We're in the top 1/3 of 1% of all real estate sales teams. We're in Gary Keller's personal mastermind, kind of the most influential person in real estate on earth. So that's a really neat distinction. We don't talk about that as much in this context, but that's a big thing about what we do. And we do some ground up construction as well. We actually are just wrapping up a 56 unit apartment building. We're getting our certificate of occupancy here in a month. We're
And
getting
we have
it.
some beautiful pictures of
It
it to
is
share with you guys
incredible looking.
today.
We're actually we're furnishing, we're staging units right now as we speak to get the best possible media and showing experience and stuff for tenant prospects. And I could not be more proud of the outcome on that project. So just a little bit about us and why we have some experience, some wisdom to share with you when we get together with you all, talk about real estate and just some background for updates on our funds.
We try to lead all of our performance updates talking about distributions because we know that's what investors are most interested in. So we're very proud of our performance to date. We have never had a capital call. We have never had capital loss, and we are making distributions on Fund 1 and Fund 2 as expected. So Fund 1 is continuing with the monthly distributions that started back in 2024. We've returned 17% of capital for Fund 1. Fund 2 started with monthly distributions in 2025, and we'll continue those. We've returned 3% to date. And then Fund 3 and Fund 4 both launched last year. So those are relatively new funds. They're both less than a year old. Actually, Fund 3 just hit its 1 year
Just his 1 year
birthday.
mark. Yeah.
Yeah, so Fund 3 is about a year old.
Happy
Fund
birthday.
4 is a little less than a year old. Our original projections were that distributions for Fund 3 and Fund 4 would start in early 2026. And no promises, but we are thinking that we may start distributions in late 2025. We want to make sure we finish the construction project at Stonehaven and some of the other things that we'll talk about in the update. But those funds are doing extraordinarily well. And fingers crossed that we'll be able to do a distribution for both of those funds in 2025. So stay tuned for more information on that. And then in Q1 of 2025, we officially launched our Secure Freedom Fund. We had soft launched it in Q4 of 2024. And in that fund, there's the option for investors to get monthly distributions of their preferred return. And so for investors who have chosen that options, those monthly distributions are going out. So that's the status on all of our distributions. We're very pleased with the security of the portfolio. We've heard a lot from investors, over the last several years about capital calls and capital loss, and just really pleased with, really it comes down to the fixed rate debt.
Yep.
And we have a slide on fixed rate debt and how secure the portfolio is. I think you guys are going to get a lot of benefit out of seeing that slide here coming up. And that has allowed us to weather the storm in the broader commercial real estate industry over the last several years. Mm-hmm. And then the other thing that investors are always curious about is your K1s. So excited to report that all of our K1s across all of our funds were distributed on time this year. We worked very closely with Hall CPA, Brandon Hall's firm. They're actually embedded in our organization as our fractional CFO, which means they're in our books on a day-to-day, week-to-week, month-to-month basis. And what that means is that when we close the books at the end of December, we get that right over to the tax preparation team. And so they're able to get started right away on getting all of those K1s ready. And we're excited that we were able to distribute all of those on time. All of your K1s are uploaded to InvestNext under the documents section. So that's where you can find the K1s now and forever into the future, so that you always have ready access to those.
And we are opening up the Secure Freedom Fund to additional investment here on May 12th. On May 12th, we're purchasing Rainbow Plaza Apartments in Anoka. We just got done walking all the units, all the common areas, every square inch of those properties. We actually have a team out there walking every single garage. We try to be as detailed as possible. We couldn't get into every garage when we were there before. We want to see inside every unit, every garage. And we'll be opening the fund for additional investment for that opportunity coming up on May 12th. The last round that we launched that filled in just a couple of days. So if you are interested, I would strongly recommend jumping on the wait list right now. So you can jump on the wait list, go to securefreedomfund.com, put your name on the wait list along with an amount of money if you are interested in moving forward with an investment. We do use that wait list to size our future acquisition pipeline. So don't put your name on there unless you really do want to invest. But we're going to have that opening up here in May 12th in just a couple of weeks. So I'd recommend having your name on the list if you would like to invest at that time.
So Monday, May 12th at 7 p.m. Central is our live webinar. So you can come to that, invite folks that you know who may be looking for a stable real estate investment to come to that. And then we do have early access. So for existing Secure Freedom Fund investors, or for those that are on the wait list, we will open the investment on Monday, May 5th. This round of raise is relatively small, probably somewhere around 2.5 to 3.5 million for the capital that we need to acquire Rainbow Plaza. So as Nick mentioned, it's likely that it will fill pretty quickly. And we do prioritize our existing investors and those on the wait list prior to our official launch, which will be on Monday, May 12th. So excited about that coming up. And then also very excited, we are getting close to our annual Real Estate Real Life event this year. It's September 11th to the 14th with an optional VIP day on September 15th. This is our second year that we'll have a virtual option as well. So we'd love if you could join us here in Rochester, Minnesota to have that in-person touch, to be able to tour the portfolio, network with other like-minded real estate investors. But if travel is difficult for you or your schedule doesn't allow, we'd love for you to join us virtually. Super excited about the event this year. Our theming for this year is all around infinite returns. So not just infinite returns financially, but return on time, return on experience, return on your network, all of the things that we have in our life that can lead to a big life, right? That's why we named our conference Real Estate Real Life. We think that the purpose of real estate investing is to live a big, amazing life. And we try to bring all of that together into one weekend during our conference. You can use the code Black Swan for $300 off of registration. And that's $300 off of general admission, VIP, or the virtual ticket. So particularly the virtual ticket becomes quite affordable with that $300 off. The website is RERL2025.com. Tells you all of the details, more than I was able to share here in just this minute together, but you can use code Black Swan for $300 off. We would love to see you either here in person or joining us virtually. It's going to be such a great event. It's like our favorite time every year. It's just so fun to have our investors together, potential investors, other real estate investors who are looking to learn about our operations and take it to your own real estate investing portfolio. You get to meet the Black Swan team. There's just so much that we pack into that one weekend, and it's just such a joy for us to hold it each year.
Yeah.
Here we go.
Let's
now we are officially at our Q1 2025 update. First, we'll talk about loan maturities.
Yeah. So this is the item. This is the big thing that's really impacting our industry. So in 2025, there's over $1 trillion. That's with a T of loan maturities coming due in the commercial real estate world. So 2024 was a bad year, and 2025 is not looking any better. A huge reason for our success is our vertical integration, our in-house property management, maintenance, cleaning. We have a tremendous amount of control over expenses in a way that most groups that use third-party property management that then hire third-party lawn services and third-party contractors don't have control over expenses. But a huge part of our success is just that we got a lot of fixed rate debt. So some of our properties to this day are sitting at 3.0, 3.25% fixed rate debt. And those loan maturities still aren't even coming up this year. In fact, we just closed on a cash out refinance of one of our properties, one of our joint venture partnerships this past week. And that's at a 3.0% rate for the first lien position. We got a second lien loan, a cash out refinance on that property. Now that one's at 7%, so that's challenging, but we're still able to achieve a cash out refi even in this interest rate environment. So there's just a lot of things that we do different than most groups that are unfortunately having capital calls or announcing outright loss of capital. Something really exciting about this topic in Q1 was that we achieved our next tranche of financing, our final tranche of financing for construction on Tanara Villa Apartments. So that was probably one of the most challenging pieces of financing we've achieved. I don't even know how many hours I spent on phone calls with different banks trying to negotiate better rates, better origination charges, and just a huge amount of effort that went into that to get everything stabilized for the units that are currently under construction. You don't want to shut down the whole construction pipeline because that's where your kind of economies of scale and stuff come with construction. So we're set for financing that has a short-term construction portion loan, and it has a long-term financing piece built into it. So we don't have any financing risk there. At this point, we have literally less than $1 million of loan maturities outstanding for 2025. That's absurd. So across $400 million of assets, we have less than $1 million of loan maturities outstanding for 2025. And that's the really lethal thing that's getting a lot of groups right now. There's no great performance benchmark, but I would estimate we're performing probably in the top 5% of people in our industry. And the way we have very conservatively structured our debt is a big piece of that puzzle.
Certainly what I hear, knowing, how you spend your time, when I hear that we only have $1 million of loan maturities in 2025, not only do I breathe a big sigh of relief, for ourselves and on behalf of our investors for 2025, but knowing how much time that frees up that we can focus on acquisitions and operations when most other groups are merely focusing on, trying to survive.
Yep.
That's why we were able to acquire so much in 2024. That's why 2025 is likely to be a record-breaking acquisition year. That's why we're focusing so much on operational excellence and growing our team, because we have the time to do those things instead of having to focus a lot of time on debt, right? We've always said that real estate investing is the deal plus the debt together is what creates the magic. And you have to focus on both, right? But right now, we don't have to focus as much on debt because we only have $1 million out of a $400 million portfolio of loans that are maturing in 2025. So that allows us a lot more of our time and focus to be on acquisitions and operations. And it is going to be a great year. It already has been a great quarter. So looking forward to the next 3 quarters of 2025. So the story of Q1, I kind of teased it there at the beginning. It's really a continuation of the story from the latter half of 2024, really focusing on strong operations, right? We just talked about loan maturities. That's a huge piece. We just talked about acquisitions. That's a huge piece. And then the third piece there is maintaining very well the portfolio that we have, right? Getting through that tough renovation phase that happens for the first several years of each acquisition, stabilizing those properties, working on leasing, all of those types of things. Our leasing team has done extraordinarily well in Q1 of 2025. We have less than 2% vacancy portfolio wide. I think, Nick, you shared with me this weekend, I think we have 17 units. I don't want to quote that number, but I feel like I remember you saying we had 17 units that potentially could be leased.
At one point, we had 17 vacant units we could lease across our, 1,400 unit portfolio.
Yeah.
That's ridiculous.
Yeah. Like, usually when someone calls,
less than 1%.
Usually when someone calls, we can say, we have everything from a studio to a 4-bedroom home. Which part of town do you want to live in? Do you want something historic, something newer? And right now it's more like, well, here's the little, basket of things that we have. Which one of these would you like? And so we're just so grateful to our leasing team for their very strong performance. Our vacancy is 2.2% lower this time this year than it was last year at this time. And that overall translates to about $500,000 of additional NOI in the portfolio, which at a 5 cap would be about $10 million of value added to the portfolio. So that's a way to show how operations is everything, right? It's just a small tweak in vacancy can, really change, either lower or raise the value of a portfolio. And so that's why we say operations are everything. We'll talk a little bit more about acquisitions as we go through our time here together, and then focusing on optimization across all of our departments. Let's talk about rent growth. So usually, right, when vacancy goes down, that often means that rent growth also goes down. That often means that you're having to do concessions or other things to lower the rental rate in order to attract residents to that particular building, so that we have low vacancy and high rent growth is, kind of opposite of what you might think. And it really speaks to the strength of the portfolio and of Rochester as a whole.
Yeah. So nationwide right now, our industry is looking at a negative 0.4% rent growth rate. So that means that if you rented an apartment for $2,000 a month or something like that, this past year in 2024, that exact same unit is going to be like $1,920 this coming year. Your landlord might be offering you a renewal with no escalation, and they might even be offering you an incentive with that renewal, like, please stay. If you stay, we'll give you a $1,000 Visa gift card. That's a common concession that we're just seeing in the marketplace right now, is getting like a $1,000 bonus just to renew your lease. That's how desperate a lot of multifamily operators are to keep a grip on their tenants that they have right now. The reason for that is a huge amount of supply entered the marketplace, more supply than has been delivered in over half a century. And it happened all at once at a time of economic downturn, when a lot of people were collapsing their households. So instead of having 2 people living separately, those 2 people are now living together, and there's actually less demand. There's political influences that are reducing demand. This is a crippling thing to deal with for most operators in the multifamily industry, because your labor costs are going up, your tax costs are going up, your insurance costs are going way up, and in conjunction with that, your revenue's declining. Our portfolio, we're achieving a 6.7% year-over-year rent growth, and that's organic rent growth. So that's not that we vacated a unit that wasn't renovated at a $1,000 rental rate. We did this deep value add renovation, and then we filled it at a much higher rental rate. This is across the whole portfolio. That is our organic rent growth rate. So that's a pretty staggering delta against the performance of the market. And I mean, that's how we're able to do distributions with great confidence in all of our funds right now on schedule because we're driving huge performance. How did we achieve this? It's one thing to achieve 6 or 7% rent growth if the industry's at 6 or 7% rent growth, but when rent growth is negative in the industry and our rent growth is positive, to give you some idea of this, I personally review every single renewal that we send to the entire portfolio, which sounds crazy, but at the end of the day, those are important decisions. So we have one person that does like a first pass of all of our decisions. Like, are we going to ask this person to leave because they're paying the rent consistently late and they're a problem or something like that? Are we going to ask them to stay? And what sort of escalation are we going to offer? We always escalate rents at renewal. And how do we calibrate that in a way that gives them an easy decision to make, but also allows us to grow our rents to keep up with expense growth? So one person makes those decisions, a second person reviews all those decisions, and then I'll come in, I'll sit down with both those people, and we will review every single renewal that goes out every month when we send out those renewals. It's critically important that these decisions are made well, and that's the level of dedication that Elaine and I have to making those decisions. The next thing is we made some pretty big changes on our team. So for years, we did not offer commission to our leasing agents because we didn't want people to be incentivized to merely fill the units. We wanted to make sure they're filling them with high quality tenants. And when you have a small organization, that can work really well. But as our organization has grown, we have I think 60 full-time employees here in Rochester now. Just here alone, there's hundreds of people doing something somewhere for us right now. It's hard to keep that culture of discipline and accountability. And so we switched to a commission-based system. So we went to all of our leasing staff, and they received in many cases like 50% reductions in base compensation, plus a commission structure. And as a result, some of our agents are, they're not making a lot of money, and they'll probably need to find a different job. And other leasing agents on our team, they're going to be some of the highest compensated people on our team. They're working 7 days a week, 12 hours a day, literally working 7 days a week, 12 hours a day.
Spend just 90 seconds talking about the truce we had to make for the morning time. Just 90 seconds.
So to give you an idea of how, and in all sales organizations, it's like this, right? You have some people that are just the top performers that when you put contingency-based compensation in front of them, they're going to outperform. And we have several of those people on our team, and they're absolutely crushing it. And I could not be happier for them. And you get innovation as a result of that you can't expect. So before we said we didn't want to do outbound phone calls to prospects until maybe 9 a.m. Wait for people to wake up, and you don't want to be waking someone up with a phone call in bed. And they started doing 8:45, 8:30, 8 o'clock, and then it eventually got to be where they were universally waking people up. That's not a good idea. So they started doing outbound email and text messages. And they started doing it at 7:30, at 7:15, at 7 o'clock. And finally we had to say, okay, well, you can't follow up with new leads. And it's a race to get those new leads right. You can't follow up with new leads before 6 a.m. because we can't, it's just a little ridiculous, right? And so now they're following up with all their existing leads before 6 a.m. so that they can, and you're not allowed to do new leads until you follow up with your existing leads. So they're doing asynchronous, like text message and email follow-ups, all their existing leads. And the process that's evolved is you wake up, and what do? You check your phone usually when you wake up, and you don't have a phone call, but you do have like a text message and an email from a leasing agent at Black Swan at 5:45 in the morning of, hey, great conversation yesterday about leasing from us. Would you like to schedule that tour? So our leasing agents are waking up at 5 in the morning to fight for new leads. Then they shower, come to the office, and then kind of start their follow-up once that hungry hippo pass for new leads has gone by. So that, as the leader of the company, I can't tell you how excited I am to see that. That's driven massive decreases in our vacancy and increases in our rent growth, as one would expect when you have your leasing agents voraciously competing to follow up on leads. And Justin, the leader of that department, handled that whole transition extraordinarily well. As you can imagine, there were a lot of really difficult conversations to have, and you wanted to make sure that the people who are going to be excited about it were excited about it, and the people who, some people are not going to be excited about that change because they're not a top performer and they don't want to wake up at 5 o'clock in the morning to get leads, and those people are probably not a good fit for our organization anymore as we've grown. So that's been a huge thing. Another huge thing is our portfolio has gotten big enough that we basically needed someone whose only job was to just walk around our assets. There are so many buildings, so many square foot, millions of square feet of real estate that we have the privilege to steward. And we just need someone walking around and saying, okay, this stairwell smells funky. We need to go put an air freshener in here, or clean the carpets or whatever. Hey, this trash can is overflowing. So that's Becky B. We have multiple Beckys on our team, and she's doing a phenomenal job. We got her a big box truck so she can, because people will roll up a mattress like a taco and stuff it underneath a stairwell because mattresses are difficult and expensive to dispose of. So a lot of what she does is find mattresses that have been hidden around our properties, and she has a vehicle to dispose of them. There's so many of them that materialize. Doing that kind of stuff. And as our organization has grown, in any given week, we need to dispose of like a dozen mattresses because we have that many units. The assets have never looked better.
Mhm.
The curb appeal, the feel when you walk in the door, just having a person whose only job is literally walk around the assets, make sure they look good, smell good, feel good. It's been huge. Our portfolio is mature. We've got a lot of renovations coming up and a lot of renovations in the pipeline. But if you rewind the clock a couple of years ago, we had over 25% of our entire portfolio in some stage of renovation. Our portfolio is now so large that it's not possible for so much of our portfolio to be in renovation. And then market vacancy has declined in Rochester, and we'll touch on that more here in just a little bit.
So let's talk about renovation. So as Nick mentioned, a couple of years ago, a staggering portion of our entire portfolio was under renovation through like Fund One and Fund Two. And then we stabilized renovations for probably about a year or so as interest rates went up, construction costs went up, labor went up. We really focused on RDS for most of 2024. And now going into 2025, we're kind of reigniting our renovation pipeline. And so very excited to bring that part of our business back. Today, we have 46 renovations in flight. 58 are coming soon. So that's things like we're waiting for a lease to end so that we can have custody of that unit to do a renovation. Just last week, we completed 11 renovations. And then some of the things we're doing now that's different from, say, a couple of years ago is having a much more streamlined scope of work. Downtime, right? The time that that unit is vacant is a significant overall cost of a renovation, but it's a little opaque, right? You can see, the bills that come for the countertop and the faucets and the labor and those sorts of things. But it's important to remember that while that unit is down and not receiving rent, that's also a form of a cost. So we're streamlining our scope of work. And then we're really collaborating with the city to focus on keeping what's called naturally occurring affordable housing and to avoid permit escalations because permits take time. Time is vacancy, vacancy is money. So collaborating with the city, streamlining, it's just a different feel to our renovation pipeline in 2025 than in, say, 2021, 22, 23, but very excited to kind of bring it back. A picture here that's kind of funny is at Meadow Park Apartments, which we're really going to talk a lot about in our Q2 webinar. But there's a picture here of a whole pallet of water. So Meadow Park is undergoing such staggering renovation. We have so many people there, not just of our own staff, but of vendors as well, that we had a whole pallet of bottled water delivered to support that renovation team. So we will talk more about Meadow Park in our Q2 update. It was so hard for Nick and I, but we closed on Meadow Park in Q2. We closed the first week of April, and we really try hard to keep our updates, focused on that quarter. But that's just one picture we had to show that was just, kind of a funny demonstration of bringing back our renovation pipeline. So very excited about all the goodness that is to come from renovations.
And just a few charts for our rent growth. Similar to what we've shown before, we've had quite staggering rent growth in many of our properties. So if you take a look at, say, Georgetown, for example, so that's an asset that we purchased recently because some of these assets we purchased a long time ago. And like Colby, for example, we've grown rents 30% there, but we bought that, a couple of years ago. Georgetown, we've had that asset less than a year. And you can see rents have gone from $12.50 to $14.50 in less than a year. And that's on an income restricted property, on a LIHTC property. It's mixed income. And people say, well, those income restricted properties, the tenants they don't have any money. So why would you make the property nice? You can't raise the rents. It's rent capped. It's income restricted. Why would you bother treating those people like they deserve better? And we think there's a better way. And the numbers show it. We have experienced extraordinary rent growth on an income restricted asset because we stepped in and we just cared and we treated the asset like a market rate asset and not like an income restricted asset. And so we're now at those rent caps in many or most of those units, and we're continuing to add massive value to that community. So staggering rent growth across the portfolio here. This is another kind of crazy number. So Rochester, Minnesota, on an annualized basis in the last 12 months, is experienced 4.7% job growth. 4.7%. Most communities, if they get less than 1%, 1% job growth, they are, just singing over something like that. This is an absurd number. This is probably in the top 20 cities in the entire country or something along the lines. Uh, you know, Rochester is leading the state of Minnesota, number one in job growth by quite a margin. It's an insane number. This is the hospital of the future coming to fruition. So we're starting to see some of those jobs materialize, and job growth is the number one driver. It's the leading indicator that you always want to look for in multifamily investments because people tend to follow jobs. So jobs are created by an entrepreneur or a business that's expanding, that's creating more value. They need to hire people, and people tend to move to that area to fill those jobs. And at first, maybe they're driving from a long ways away. They live in Minneapolis, St. Paul, and they'll drive down to Rochester, commute for a year, and then eventually they decide to sell their home in Minneapolis, buy a home in Rochester, or rent an apartment here. And you typically see vacancy and rent growth follow job growth on a 12 to 24 month lag. So this is an incredibly encouraging number to see. And as much as I want to sing the praises to our team for the incredible dedicated work that they're doing to grow rents so much at this challenging time in our industry, I mean, this is a huge part of it. Is we picked a winning market, and that market is winning.
In this particular quarterly update, we don't have any particular updates on the Destination Medical Center initiative or on the Hospital of the Future expansion from Mayo Clinic. But if you're new to us or you aren't familiar with what I'm talking about, either go back and watch the quarterly updates through 2024, where we spent a lot of time talking about those, or you can just Google it, Destination Medical Center, Rochester, Minnesota, Hospital of the Future, Rochester, Minnesota, and see what we're talking about in terms of the extreme economic expansion that's happening in Rochester and why we've always been so proud to call Rochester our headquarters. So those are all of our kind of portfolio-wide updates.
We have 4 different apartment buildings today with no water because because Mayo has shut down so much of the water supply because they're building out so much infrastructure. So just try to wrap your brain around that. We have 4 different apartment buildings with no water today. Think about the scale of work. There's a 200-foot deep hole because they're building in an underground tunnel with 50-foot ceilings. It's a staggering amount of work that's happening, and job growth and incredible prosperity for the future.
Next up are our updates for our short-term rental portfolio.
Yeah. So if you've followed our updates, we've been very transparent as we've gone through this journey, this experiments together. But let's recap that. So if you rewind the clock to fall of 2023, we were celebrating our first short-term rental unit coming online. Elaine and I were there with our kiddos, scavenging furniture that materialized in different parts of the portfolio. Sometimes we would inherit some stage units or furniture units or whatever, and then buying, testing this set of knives from Costco or whatever, unwrapping that with our kids and furnishing those units kind of in our evenings and stuff like that. We tested a few units, and we had a hypothesis or a set of hypotheses. So our first one was that we were about to experience way more vacancy than we could ever possibly fill. So if you'll remember, a few minutes ago, I mentioned that 25% of our portfolio was down for renovations in 2023. We had at 1.77 concurrent rehabs. So right now we've only got, was it 43 or something like that, concurrent rehabs. We had 77 concurrent rehabs at that time. And so
in a smaller portfolio.
Yeah, in a way smaller portfolio.
Our portfolio is probably 400 units bigger
now.
Yeah.
So we're like, okay, well, we're going to finish these rehabs. And like, it's just, and this is going to go into the slow season. And there's no way, it's mathematically impossible that we could ever fill these units. And it's probably not going to be possible to fill these units until we get to like the next high season. Some of these units could be vacant for quite some time. What can we do? There's an opportunity to create value. So we could furnish some vacant units and basically create free revenue from those units. We could do that at RDS. So we could run kind of a pilot program on our vacant units that winter. Then RDS had this conundrum where we were bringing all these new units online, and then we were up against the clock to get new financing on that property. And it takes time to do a lease up. You don't just snap your fingers and all those new units that you're building are full and producing revenue. But short-term rentals are different. They do produce revenue immediately. So if things went well through that winter of 2023, 2024, then we could bring units online in the summer of 2024 at RDS, and then use that to support refinance proceeds and do this kind of opportunistically. So if there's a unit that isn't leasing or whatever, we're gonna fill that with an STR. We could use all the additional staffing that goes with that because you're doing turnovers, laundry, that sort of thing. We could do that to achieve a full court press at RDS because we knew we were pulling off such an incredible turnaround of that asset. I mean, there was days I'd walk into that asset and there'd be a dozen of our staff members there in the building doing something, and the SDRs would support that. And then we knew one way or another, like that experiment, it would cost money to like buy all these furnishings, but it would almost certainly pay for itself in that additional like free revenue that was generated. So let's see how that experiment went. So we mentioned changes in vacancy. So Rochester has kind of mirrored the national trend. You can see if you go back to 2022, we were at 6% vacancy. So 5%, 6% vacancy is sort of like a natural equilibrium point, kind of like 5% unemployment or 2% inflation. Those are points of economic equilibrium that you're trying to shoot for. If vacancy gets below 5%, you tend to get some weirdness in the housing market. Sometimes rents will just skyrocket unexpectedly or crash as you go above and below those equilibrium points. And to go from 6% to 11% vacancy in a market our size, that will make your head spin. And for it to go up that fast, what that means is you have a lot of new supply coming online, and all those beautiful new Class A buildings are offering steeply discounted rents with insane move-in bonuses. Like, oh, here's a $2,000 Visa gift card if you'll rent a unit today. And there's literally people like handing out flyers on the street and stuff like that. That's difficult to compete against when you have a B class building or something like that down the street that's competing with that. So you can see we started that experiment in 2023, knowing that this thing was happening, this thing was coming, and we were able to kind of ride that wave of market vacancy by spooling up a ton of short-term rental units. Let's look at what that looks like here.
And one of the questions that came from Jenny is restating how rent growth correlates with vacancy. So in a typical market, when vacancy goes down, rent growth also goes down. You can kind of think of it as like the units are on sale in order to attract customers, right? So that we are having decreasing vacancy at the same time that we're having rental growth increase is kind of opposite of what you would see. And it speaks to the strength of the overall Rochester market and the strength of our particular portfolio. So I thought that was a good question to answer here while we're talking about the overall vacancy in Rochester.
Yeah, so we had that one unit in October 2023. We had 3 units in January 2024, 28 in May 2024, 47 in July 2024. We had a full court press. We had our whole team out there furnishing units, trying to make sure that these units were delivering revenue as quickly as possible. RDS was our main focus, and then we tried units in our other buildings just to see how relatively successful or unsuccessful they would be. Then if you rewind the clock and look at our last 2 performance webinars, we talked about basically opportunistically unwinding the less profitable STRs, deploying those furnishings to like the more profitable STRs. So some unit types, some buildings did better than others, just kind of tweaking that mix to the best of our ability. And that actually kind of went to its natural conclusion here, where we started growing rent, our vacancy started going down, and it quickly got to be the case that we were more profitable on long-term rental for the vast majority of those units, which is a fantastic problem to have, right? So some of our units were like $800 more profitable per month as short-term rentals than long-term rentals. They were extremely profitable, but many of our units were like $100 more profitable net of all the additional expenses as short-term rentals than long-term rentals. And short-term rentals, the revenue is fickle. It goes up and down. Lenders underwrite to that revenue with a bigger handicap because that revenue is less sticky and you're eligible for essentially worse quality debt. And so as we wound down our less profitable SCR units, we ended up with a smaller and smaller portfolio until we got to a point where even though we're getting significant additional revenue from the STRs that are operating, it's not worth the inferior debt that we'd be eligible for at some point in the future. Let's take a look at this financially here. In June 2024, we were delivering an extra $7,000 of monthly NOI, about $82,000 a year. That would give us about $1.6 million additional portfolio value. And critically, this got us through the refi on RDS. Like all of this was worth it just to get through the refi on RDS. Then 2024, revenue started going down on some of our units, started unwinding them, and brought us to where we are today. So overall, I would consider this an extraordinarily successful experiment. Our hypotheses were mostly confirmed, not all of them, but most of them. We produced a ton of free revenue. We produced a ton of fast revenue that got us to our refi on RDS. We got our full court press at RDS. We figured out that you can produce a ton of additional revenue with SCRs, and some of our units in particular, they were producing $5,000-$6,000 a month in gross revenue compared to $2,000 a month that you get from an LTR. That's huge, but there's a lot of additional overheads that go with that. labor costs and supply costs and linen costs and that sort of thing. And on the balance, in our market at this time, we're doing so well on long-term rentals that it doesn't make sense for us to continue that line of business. It's not something we can do at scale. Maybe if we were solo operators that were doing our own turns and kind of being really scrappy about that, we could only afford a small portfolio. It would still make a ton of sense, but we can't do it at scale. Where we land in terms of like financial outcomes, the assets, massive win for RDS. I mean, RDS were ahead millions of dollars, millions of dollars. Our other assets where we kind of did the experimental units, it's probably a break even overall. Our property management company probably lost about $250,000 on this experiment. At the end of the day, though, this is probably just table stakes, right? Like this was a very profitable line of business for 1 unit, for 10 units. We went to 50, and then the expenses just started to kind of outstrip the revenue, and then just our long-term rental business just started killing it in a way it never has before. So that's kind of where we landed on this experiment. We're hoping to have everything wound up here by probably June, July timeframe. We'll make sure to get you an update at the next performance update webinar. And if people have been asking questions, feel free to throw questions in the chat. We can get those answered here at some point as well.
I think we've answered most of the questions that have to do with short-term rentals and with vacancy and those sorts of things. One of the things that I want to mention is a lot of times people ask, why are we vertically integrated? Why do we focus on property management instead of just asset management, right? Which would be like asset acquisitions, investor relations, those sorts of things. And for a lot of reasons, it's because we do large scale renovations, and it can be very hard to get a property management company to just move the boulder that you have to move for renovations. But it's also things like this, right? To run this, kind of sprint experiment for like 18 months. And then to pivot, it would be very hard to get a third-party property management company to agree to that, right? To change the strategic plan, to spool up staffing, to move staffing from other departments. And that this is a big part of the reason we do vertical integration, is that we can pivot very nimbly based on what the portfolio needs, what specific assets need. And so that's a huge win for vertical integration, is the short-term rental line of business that we've had over the last year and a half. So very excited about that update. And as Nick mentioned, we'll have more updates as the year goes on. And then for our updates here, we typically start with fund 1 and kind of work our way up. We're going to go the opposite and start with our newest fund and then work our way back as those older funds are becoming just so mature. There's not a ton of updates there, although every fund does get an update today. So let's first start with the Secure Freedom Fund. We soft launched this in Q4 of 2024. We bootstrapped this with capital from Nick and I for an acquisition called Northern Place Apartments. And then we officially launched this fund in Q1 of 2025. And then, as we mentioned at the top of the call, we'll be opening it for new investments on May 12th. So the way this fund works is it's a $100 million fund. It pays a 10% fixed rate of return. Investors can elect to receive monthly distributions if they're looking for passive cash flow, or they can allow their returns to compound. And if they choose that option, they compound monthly for significant accelerated growth. And as we acquire more assets, we will open and close this fund. So when we opened it a little earlier this year, we raised about $4 million for some of the acquisitions that we had. Then we closed it. When we open it in May, we'll raise about $3 million for the Rainbow Plaza acquisition, and then we'll close it. And then we'll just keep opening and closing it until we hit that $100 million total capital raise over the next several years. The acquisitions that we have in it to date are Northern Place Apartments and Meadow Park Apartments. We're under contract on Commerce Drive, and we're under contract on Rainbow Plaza. Both of those will close in Q2 of 2025. So this is how the fund works. As I mentioned, it pays a 10% fixed rate of return. And if you read the PPM, you'll see that we have 4 classes, class A1, 2, 3, and 4, with a graduated return rate. But for right now, we're offering class A1 for all investors, regardless of investment amount, which usually class A1 would be investors at $1 million or more. Because our goal right now is to grow our investor base, to grow relationships. We've heard from a lot of people over the years that either you're invested in all 4 of our original funds, so maybe you have 4 or 500,000 already placed with us and you're looking for a smaller amount, or you'd like to start your investment relationship with us at less than 100,000. So the minimum for the Secure Freedom Fund is just 25,000, and at all investment amounts, it pays that 10% fixed rate of return. I talked about monthly distributions or the compounding option. And then it's important to note that this is an equity fund. So even though it feels like a debt fund because it has a fixed rate of return, it is an equity fund, which means that this fund owns assets. It doesn't lend money to other assets. It's not rescue capital. We're not, a hard money lender, those sorts of things. This fund is the owner of these underlying assets, which means that it's a preferred rate of return. It's paid on a K1, and that drastically reduces tax liability being paid on a K1 as opposed to a 1099, the way like a typical debt fund would be paid. Here's the table for either the monthly option or the compounding option. For a $100,000 investment, the distributions would be $834, and those would be paid on the first of each month. Your capital starts earning your return the day it's deposited, and you earn that return all the way until the day that the capital is returned to you. And then there's the table there for compounding. And so you'll see over just 1 year of compounding, the effective annual return goes up to 10.47. Over 2 years, it goes up to 11.57, and then on and on there. So all of this is available at securefreedomfund.com. This is just a quick primer on how this fund works. You can catch the webinar that we did in February at securefreedomfund.com. We're going to have that next webinar on May 12th. All of the information is available there at securefreedomfund.com. Please do review all of the information as you're making an investment decision. There's more to it than we're capturing here in this performance update, but wanted to share about Secure Freedom Fund because this will be the vehicle that we'll have for our investors over the next several years. Here in this picture, in the lower left corner is a picture of a single family home. So this fund will have some single family homes. In the middle is Meadow Park, which we closed the first week of April, and we'll have lots to share about that asset in our Q2 update. On the lower right is Northern Place Apartments in Austin, Minnesota that we closed in December of 2024. And then on the upper right is Rainbow Plaza, which is in Anoka, Minnesota. We've completed all of our due diligence. We're working on our loan assumption, and we anticipate closing on that in mid-June. So lots of acquisitions over the last several months, many more to come. Very excited about our acquisition pipeline and all of the opportunity that's available in the Secure Freedom Fund. Also at securefreedomfund.com, you can find Nick and I's calendar. If you have questions as you're making your investment decision, feel free to block a time on our calendar. We're happy to answer any questions you have. That's our update for the Secure Freedom Fund.
Yeah. Talking about Fund 4. So we've got some exciting new construction stuff here. We'll do a ton of photos and stuff when it gets a little bit closer to complete, but we're darn close here. We're about $400,000 under budget. We're slightly ahead of schedule. We've already leased 12 of the 56 units in that building. So it's just going amazing. Like, I don't want to jinx it, but it's just going absolutely insanely amazing. So could not be more proud of our outcomes at Stonehaven Apartments. Here's a couple of photos. We've got some finished units. Those are the quartz counters, stainless steel appliances, premium cabinetry. I could spend hours talking about all the little tweaks and vaulted ceilings in this unit, magic packs. It's just amazing. It's absolutely amazing.
It's so beautiful. Every time we tour Stonehaven Apartments, we changed a lot from Stonehaven townhomes, which we've been building over the last several years, to Stonehaven Apartments. Like, for example, in Stonehaven townhomes, we were still using satin nickel finishes, and in Stonehaven Apartments, we went with the matte black, and it just looks so good. We're so excited about Stonehaven Apartments. Next up are our updates for Fund 3. So as a reminder, Fund 3 closed in February of 2024, so it's just over a year old. This is a $15 million fund, and it owns multifamily buildings in both Rochester, Minnesota, and our secondary market, Tacoma, Washington. So it owns Uptown Apartments, the Viking House Triplex, 2 single-family homes, Bayswater and Baycrest, which are both in Tacoma. And then it owns half of Georgetown Townhomes and half of Boulder Ridge Townhomes. Those are both co-owned with Fund 4. So a really nice basket of assets in Fund 3. Diversification from apartments to townhomes, diversification from Tacoma to Rochester, even Boulder Ridge, which is slightly outside of the Rochester market. And very excited about how Fund 3 has performed in 2024 at a time when most groups were not acquiring because they were just kind of treading water or even drowning with their existing portfolio because of variable rate debt. Remember, we had all fixed rate debt on our existing portfolio. So we had investor confidence. We had operational space to be able to acquire in 2024. And you're able to see those outcomes in Fund 3. So Georgetown and Boulder Ridge, as I mentioned, they're half owned by Fund 3 and Fund 4. And next up, we have some updates on those two communities.
So much amazing stuff happening here. There's a 0 vacants that we can lease today. That'll be a common theme as we go through some of these slides quickly. We've got a huge number of renovations that are in flight or that are coming up. You saw the extraordinary rent growth again. This is a mixed income restricted community. So there's caps to maximum income you can make or rents we can charge. And we've done tons of things. So for example, out of the 132 townhomes, 120 of them had individual gas meters. 12 did not. And so as a result, the previous ownership group and management group, they were just paying the gas bill on about 30 of the townhomes. And we said, no, that might be like the easy thing to do, but it makes more sense for us to work with the city, with the utility provider, with a plumber, and go get gas meters installed on all the units. And then the tenants can pay their own gas bill. So we're going to reduce our gas bill in this community by 90%, And that work just finished here in the last week. So that's a massive impact item. There's just a huge amount of value add projects. We converted the model unit into a rentable unit, and that leased within 1 month of owning the asset. Working with the city on trying to convert the office into a rentable unit as well, because this is a very low touch asset now that's starting to kind of get up to speed. And we just don't need that office anymore. And we can have a 133 unit community and add, probably $100,000 of equity to that project. We've got a whole energy savings program implemented that's reduced water. We got a stop work order from the city because we're always pulling permits, and like an HVAC inspector came out and they saw, like, imagine just a mountain of toilets. There's like construction dumpsters everywhere. And they freaked out that we were replacing too many toilets. I don't even know what the issue was. We replaced every single toilet, or we've replaced 3/4 of the toilets now with ultra high energy saving, water saving toilets. So there's a huge amount of work happening on this asset, and our outcomes have just been staggering. This has been one of our most successful acquisitions ever.
It's halfway between our office and our home. So we drive past it many times per day. Our children are like, please don't pull in. We don't want to go drive through Georgetown. Let's just go home. And we're like, no, sweeties, we need to take a quick look at it.
Thing is on fire.
And then next up is Boulder Ridge. So Boulder Ridge was a mammoth acquisition because we did a HUD loan assumption. And if you want to know the definition of paperwork, you should do a HUD loan assumption.
Thousands of pages of paperwork.
You have to hire attorneys to interact with their attorneys, and then you have to hire consultants to interact with their digital portals that are from 1995. Nick and I just chose to have just a ton of humor with it the whole way through and just do whatever paperwork they asked of us. And it took about 9 months to do that HUD loan assumption. But we are officially closed in Q1 of 2025. And the interest rate on that is, remind me.
4.5. I should probably know that number off the top of my head.
Rachel, can you pull up the interest rate? I think it's 4.3. But since we're on a performance webinar, I want to make sure we get the right number. So Rachel will pop that into chat for us. But it's fixed, right? It's a fixed rate for over 30 more years. So it was really important that we not just acquire this asset, but that we have that loan assumption with it as well.
There are 0 vacants that we can lease today.
There are 0 vacancies.
We leased three units last week. So incredibly successful outcomes. We weren't totally sure what our outcomes were going to be. This is a new market, we have local site management there. We literally brought that site management to Rochester and trained them for 9 months. We hired that person when we started that assumption process, just so that person could get all the Kool-Aid, all the mastery that they needed to operate that site the way we like to operate sites. And it's been extraordinarily successful.
Rachel chimed in with our interest rate. It's 4.47% for the fixed rate debt.
I was off by 3 bips.
For Boulder Ridge. This has been a relatively smooth transition. So we acquired this community from a very large owner operator called Common Bond. They've expanded to 10,000 units over the last about 3 years and really have struggled with maintaining the operations of those communities. So they are minimizing the size of their portfolio, really honing in on a specific geography, and getting rid of some of their assets that are in different geographies. So that's how we were able to acquire Boulder Ridge. And the closing, kind of showed some of those operational challenges. So as Nick mentioned, we had our site manager working in this community even before we closed so that we could get to know the residents. We could keep up on maintenance tickets. We could get lease ledgers. When we closed, we didn't necessarily have all the paperwork that we would have liked in terms of leases and payment records and those sorts of things. But because we had such a strong relationship with the residents there, we were able to get everybody onboarded, really start to cure a lot of the backlog of the maintenance tickets that have happened over the last several months during that transition, and very excited about providing a really high quality living experience for the people at Boulder Ridge. There was a bit of a, kind of a feeling from the residents there of like, hey, we've been kind of abandoned by property management for the last even like several years. Like, are you going to take care of the community? And they've just been so pleased to see that we have someone there every day, that we get back to them very quickly, that we're very responsive on maintenance tickets. And so it's been really nice to have this community. It's a beautiful community in a beautiful area with beautiful floor plans. Go back and listen to our prior performance updates where we talk about the floor plans and the build of this community. And then also to see the goodness that we're able to create with these residents by providing that high quality property management piece. And then it's this same group that we're acquiring Rainbow Plaza from in Anoka, Minnesota. So excited about that relationship over the next several months and years, whereas they are winding down their portfolio, we can strategically acquire things that make sense for our portfolio. So Boulder Ridge was really just the first of what we hope is many transactions that we do with Common Bond.
One other fun thing about this kind of meta, but the broker that sold this portfolio, we struggled to do business with some of the Minneapolis brokers, and this broker was one of the not the top broker in the area. And since things have shifted in the industry and a lot of operators are having a hard time, their client roster has been doing pretty well, and they're now the number one broker in the Minneapolis-St. Paul metro, which is one of the largest markets in the country. And so that tells me that we're doing something right. When the bankers, the investors, even the brokers that we work with, they're all doing well right now at a time when most people are not doing well. That tells me that we're doing something right. And we were offering on things in the Minneapolis-St. Paul area for years, and we would just we'd never come out on top. We just weren't willing to pay enough, I guess, or I don't know what. And so it's been just a really beautiful thing. It's been very validating to go through this whole cycle.
Jenny asked, is Rainbow Plaza a HUD loan assumption as well?
No, we're assuming a Freddie Mac loan plus a second lien from Mercy Housing. That's a nonprofit affordable housing loan agency, and that's a soft pay loan. So your payments are optional. Typically, only nonprofits can get those favorable terms, but these are really critical relationships for us to build. As we're looking at constructing new LIHTC, new income restricted housing, and it's kind of an inside game. So we're kind of buying a seat at the table with some of these critical stakeholders like Mercy Housing. So we're assuming two different loans on that one. Won't take 9 months though, should take 60 days. We're already pretty far along in that loan assumption process, and we feel good about a July timeframe closing.
Next up is Bayswater in Tacoma. So we acquired this in May of 2024. Right now, we're doing just minor updates. We are planning on doing a major renovation in one of the units that was heavily damaged by the outgoing resident. And that'll be our test case for the rest of the renovations. But really, the story of Bayswater is just holding it and doing steady operations through 2025. Bayswater is currently a LIHTC community, and the LURA, which is the land use restriction agreement, that lasts for 30 years. And then after that, the community can be transitioned into a market rate community, and the LURA expires in 2026. So the story for Bayswater is just good, stable management through 2025, and then transitioning it to a market rate community in 2026 when the LURA expires. Mm-hmm. Next up is Bay Crest. This is also in Tacoma, completely unrelated to Bayswater. It's just a complete coincidence that we acquired communities at the same time with nearly the same name. They're completely unrelated. This is a 30-unit community. 25 of the 30 units are currently leased, and 5 are down for renovation right now. We're working on improving the unit quality, increasing the rental rate. And then the big thing in this community right now is taking care of the plumbing stack. So one of the big value add projects that we try to do in as many communities as possible is putting in-unit washers and dryers in. It's kind of it's like a yes or no for residents, right? It's not even just like a rental rate change for residents. It's like, are pets allowed? Yes or no? Is there in-unit washer and dryer? Yes or no? That's criteria that a lot of potential residents look for. So first we need to update the plumbing stack in Baycrest, and then we'll be able to add that in-unit laundry. So this one is, doing well. I would consider this one to be in the thick of renovations right now, right? To have 5 out of 30 units currently in renovation and then to be doing a major plumbing renovation is a lot for a 30-unit building, and excited to see how this one goes over the next year.
Uptown Apartments is doing absolutely amazing. When we first bought this property, it was about 30% vacant, and the existing management group, competent management group, leasing is not necessarily their strong suit, but they were kind of at a loss as to understand why they were struggling to lease there. And we're like, well, I think we can do better, but we're not sure. And we had kind of a slow start to it. Actually, it took us a while to lease that first batch of units, and we didn't push rents as hard as we kind of hoped to initially. But as you can see on that chart, rents are now up considerably, and we have 0 vacant units that we can lease, and it's finally a quiet, stable asset like we hope to have. So doing extraordinarily well with Uptown Apartments in Fund 3.
Those are all of the assets in Fund 3. So next up, we have our updates
I like how we're like counting down.
for Fund 2.
Yeah.
4, 3, 2. There we go. There we go. Love it. Tanara Villa is the largest asset in Fund 2, and it shows. Tanara Villa has taken a lot of the capital from Fund 2, a lot of the time and focus, a lot of the renovation bandwidth. It has been just a staggering turnaround. And you can see here in January of 2023, at time of acquisition, rental rates were about $11.50. And today our average rental rate is about $14.50. And that's not even with all of our units renovated. So average rental rate will continue to go up as we continue to renovate those units and turn those units. The big story for Tanara in Q1 of 2025 is that we completed our construction loan refinance, as Nick mentioned at the top of the call. That was a huge boulder to move, a lot of negotiations with a lot of different banks. Very excited to have that in the rearview mirror and to have stability in this project going forward. We have permits issued for 43 additional units to continue the huge construction turnaround here. The community room is complete. We're completed with our exterior landscaping. We don't have pictures of that in this one, but you can look at prior performance updates for that. So this community is, probably our largest turnaround in Tacoma. We've had communities that were in like greater states of disrepair in Tacoma, but they were smaller. Tanara both needed a large scale renovation, and it's a large community. And so we're renovating almost every single unit, almost every single common area, all of the hallways, all of the light fixtures, the community area, the largest exterior renovation we've ever had in the entire portfolio. There was basically just a big lawn in between the 3 buildings, and we put in like outdoor living space there, like a pergola and a pickleball court and a dog park and things that people want these days, right? So
2 dog parks in that one.
2 dog parks. So just huge renovation at Tanara Villa. This is one that will continue to be in kind of the thick of that renovation for probably another, would you say, a year, 18 months?
18 months, yep.
Yeah, so really in the thick of that, and excited to see, if you're in a place where you can take a look at the screen, take a look at the rent growth chart that's shared for Tanara, and that's going to continue as we continue to tick through the renovations there at Tanara.
Kensington Lorison doing absolutely phenomenal. We're closing in on kind of the home stretch of our renovations there. Incredible rent growth. The quality of this finished product is absolutely staggering, especially given the cost. So some of these renovations we're spending, $10,000 or less, and we're still getting like luxury hotel level finishes. Just incredible construction crew that we have in the Tacoma market. We expect probably within the next few months, we'll be getting close. We'll call it done. Never quite done. I think there's maybe 3 units we haven't fully renovated, but they've got long-term tenants in there, and in the near future, our loan is going to convert to the permanent financing. So we'll be out of the construction financing portion of the loan. We don't need to get new financing. Again, we have basically no loan maturities coming up right now, and we locked in extremely favorable financing back when we got this loan. When we purchased this building in Fund 3. So, I'm sorry, this is Fund 2. Yeah, Fund 2.
Fund 2. Yep. I love what we did at Kensington Lorison. You can see there we did darker trim around the windows, and then we have cabinets here that are a little bit different than anywhere else in the portfolio. And I really like the way this one looks. It kind of blends a little bit of that historic charm, but really modernizes the
100-year-old urban core Tacoma buildings, and yeah, they look incredibly sharp for doing rehab on 100-year-old buildings.
Next up is Garfield. This is a mixed use building. There's some commercial units on the ground level and then some residential units above. A relatively small community overall, and we've just kind of allowed this one to organically turn over. So those units continue to turn over. We continue to do some minor renovations there, like new flooring, new paint. You can see here we kept some of the existing cabinets and some of the existing appliances. This isn't student housing per se, but it is housed right where students at Pacific Lutheran University would walk as they go to and from class each day. So a lot of the residents here are students, and these are great units for them because they're relatively small, relatively efficient units. And then the change in the feel from the commercial bays has really been staggering. We've vacated and allowed the leases to expire from the commercial tenants that weren't really adding value to the community and brought in things like a coffee shop, a restaurant, things that make sense, right, for the demographic that's walking on that street every day. It feels so much better. There's so much light there now. It feels like the vibrant community that we saw when we acquired it. Garfield was very ugly when we acquired it. It was one of the few acquisitions that I'm like, Nick, what are you thinking? now we see it. And so it's stable. It's doing really well. And there's the beautiful chart there of the rent growth since January of 23. Rents at that time were about $7.25, and rents in March of 2025 are about $12.25. So very pleased with the financial performance at Garfield.
Mm-hmm.
One of the questions came up so the rent growth is amazing. Is this reflective of the pre and post rehab? So the way these rent growth charts work is we just take the rent roll from that time, the average of the rents. And then, so for example, the average of the rents in 2023, and then the dates that you see there, June of 23, September of 23, December, on, all the way to March of 2025. So it blends into there in any given community, both the organic rent growth that happens from renewals and then also the rent growth that happens from the renovations. We don't like segregate out which units are renovated and which units are not. We just report on the average rental rate in that community over time.
That's a critical distinction. So most groups, what they report in on is, well, we did renovations and we got a $200 rent bump or something like that. And they exclude their classic unit rental rates, and they just look at like what's the highest achieved rental rate on a renovated unit. What we're showing you is the average of every single unit, renovated, unrenovated, and we renovate them so quickly that it's very difficult for us to get that top of the market rent for the renovated units. In this case, we were at $725 a month, $725 a month on Garfield in January 2023, and that's when we purchased it, was January 2023, and we're at $1,200 a month right now. And that's across all units. That's not just like the highest achieved rent in our renovated units. So pretty staggering rent growth on that particular property. And,
yeah.
The biggest community impact I feel like we've ever had. Maybe Meadow Park might beat it, but huge positive impact on the community there.
Yeah, I'm gonna just hop back just for a second to Tanara Villa.
Yeah.
That we're talking about this. That you can see here. Take a look, if you're able to take a look at the screen, of the rent growth that's happening since acquisition. And we still have more units to renovate, right? We just pulled permits on additional 43 units. So that rent growth is going to continue, not only from organic rent growth in the community from renewals, but from the forced appreciation, for lack of a better word, from the new rental rates from the renovated units. We expect that to continue to go up and to the right over time as we add more units proportionally to the whole community that are renovated versus the non-renovated units. Excellent question there. Another asset in Fund 2 is Dakota Townhomes. We were able to execute a cash out refi of Dakota Townhomes in December of 24. We got $2.4 million of loan proceeds for Dakota Townhomes, and that went into acquiring units in Riverview, which is also owned in Fund 2. The basket of assets in Fund 2 is huge, right? Fund 2 is a $30 million fund. And if you think we typically had like 20 or 25% down, it's like well over 150 million of asset value. And so we're using the proceeds from this acquisition to continue to acquire assets in our Riverview acquisition. And it's just been really nice to see this basket of assets grow. We rebranded this community to Dakota Townhomes, and right now it's really stable. So at the time, Georgetown was one of the hardest acquisitions. I was personally involved more in Georgetown than any other acquisition we'd ever had. Dakota now, but it was Georgetown. I'm sorry, Douglas. We have so many male names in the portfolio. Sorry, guys. it had been named Douglas Trail. We changed it to Dakota. Um, at the time that we acquired it, over 50% of the units had some level of rental delinquency. So we had a staggering effort to work with those residents, help them get assistance, vacate the residents that didn't want to participate in getting caught up. It was just a huge undertaking. There was a time when I didn't believe that it would ever be stable. And today it is very stable.
82% renewal rate on,
Yeah.
on that community.
Yeah,
It's incredible.
97% occupied, really nice rent growth. Townhomes are just kind of a low touch asset. There's not a lot of, well, there's, no common living space, right? You tend to be shielded from things like noise complaints and those sorts of things. People have their own backyards. It's just a really beautiful community. We drive through this one almost every Sunday because it's really close to our church, and it is just stable and doing really well. So very excited to see, like, in 2022, when we acquired this asset, I would rate it like a 9.5 out of 10 in terms of the level of complexity of this transition. And today it's, in the top 10% in terms of stability in the portfolio.
All right, just a few left here. Riverview. We've acquired 59 of the 62 units in the building, and we're just using liquidity in Fund 2 to purchase that. There's 0 vacant units we can lease today. We had more STRs in this property than any other property other than RDS. Very successful STRs here, so we're going to lease a bunch of those here soon. Rental rates have grown quite a bit on this asset. Just it's stabilized, and so the rent growth chart looks like it's going in the wrong direction. That's because we were putting the nicest units into services STRs. That's going to turn around here sharply as we take those units out of services STRs and put them into places in service for long-term rental.
Next up is Colby. This is a smaller community in Fund 2, just 32 units. Renovations are complete. We acquired this acquisition with cash in Fund 2, and we did a majority cash out refi about 9 months later because it was such a huge turnaround. And so we're just holding it and operating it at this time. You can see the renovations there. We did new paint, new flooring, just kind of gently touched up the units. We didn't do a huge scale renovation here because we're hoping that we would redevelop this site. When we say soon, we mean, on the scale of years, but working with the city, working with agencies for like tax, what's the word I'm looking for?
Tax increment financing,
tax abatement. Yep. Tax abatement. I was going to say tax credits. I knew that wasn't the right word.
We're trying to get all of those things. So they're all correct words. Yes.
So those things take a lot of time. Yeah. But having those conversations, we've worked with an architect, we have a building plan, we have unit mix, all of those sorts of things, but that's on the order of years. So in the meantime, we'll just continue to manage this community. It rents really well. It's right within walking distance of the hospital campus of Mayo Clinic. These units are kind of a mix between like a studio apartment and a 1-bedroom apartment. So they attract a lot of young professionals. It's just that the community has a really nice vibe to it right now. And then one of the things that's really exciting is this community sits right on the bus rapid transit line, the BRT line. So not only is it just, completely walkable to Mayo, but when that bus rapid transit line is built over the next several years, it will connect it to even more things. A lot of the folks who live here are carless, and so they're able to get to like a grocery store, a couple of restaurants, Mayo, but with the access to the bus line, they'll be able to have even more accessibility in the community. So excited about that. Stay tuned. I would say we'll redevelop this in
sometime in the next several years.
28.
We'll see.
Something like that. We'll see.
Yep. So a lot of groups, they said they need to survive till 25. Well, 25 came, and a lot of groups are still really struggling. And so what I'm hearing now is wait till 28. And we'll see what happens there. On the new construction front, interest rates are high, construction costs are high, tariffs are probably going to make them higher. So it's unclear what the future outlook looks like for new construction. There probably won't be a lot of new construction in the multifamily space, and that will be a very good thing for people that own a lot of multifamily. But it makes it harder to make the numbers work on new construction. It was already kind of required that you get some sort of city subsidies and stuff. And Rochester has been so successful that they haven't been in a hurry to give us any generous subsidies. I perceive that climate will probably change at some point here in the future, and to a certain extent, it very much is a waiting game. So until you've waited for a while, the city isn't going to give you a lot of subsidies. Okay, they've had it for a few years now. Well, I guess we do need to give them a subsidy in order for them to redevelop this asset. So
Next up is Residents at Discovery Square, RDS. This community is half owned by Fund 1 and Fund 2.
RDS doing amazing. There are zero vacants, or no, I'm sorry, there's one vacant we can lease right this second, one of our main floor units, but still incredible for a 150 unit asset at peak churn time of the year. And we have all these units coming out of short-term rental, and there is one unit we can lease. Being absolutely amazing. We got our new financing in place last fall, which is sort of a heroic achievement. Just got absolutely phenomenal financing terms on that. So we've got 2.5 years left on that current tranche of financing, and all of our numbers right now indicate that we're going to be in a really good spot to achieve a significant cash out refinance event when that current tranche of financing expires. There's a lot of updates we could give here. It's a busy beehive of activity always, but it's doing amazing. This is certainly, it's our biggest, most prestigious asset in the portfolio. Always have tons of staff there, tons of activity, and this asset is just doing amazing.
And then finally, we have Black Swan Real Estate Fund 1. So Black Swan Real Estate Fund 1 owns half of RDS. It owns Nicholas and Oliver. And then it has a small portfolio of single-family homes. So Fund 1 owns 30 single-family homes that were principally acquired in 2022. And the update that we have to share here is that we have one vacancy, but that home is already leased. And then we're showing what are called the Move the Market reports that Keller Williams puts together. So this comes from MLS data, and it's all of the home transactions in Rochester for that month compared to that month the year prior. So we're sharing February of 2025. And really what I want you to hone in on there is the year-to-date home price in Rochester is now over $400,000. It's at $406,000, and it's up 13% compared to 2024. Many markets have struggled, right? Single family homes, just like multifamily, have struggled in many markets because of rising interest rates. It's harder for families to qualify for a mortgage or to afford that mortgage payment. And Rochester just is such a strong market. It just seems to be kind of oblivious to the fact that interest rates for mortgages have gone up and has continued to enjoy double-digit appreciation year over year. So that's really the big update for Rochester. For Fund 1. Is that the single family home portfolio is just kind of churning along. Yep. And just market appreciation is kind of carrying that portfolio. And clearly they're very in demand because we only have one vacancy that's already leased out. Mm-hmm. Those are all of the updates for all of our funds. Just a little summary here, and then we'll wrap up. If you have any questions that we haven't had an opportunity to answer yet, go ahead and drop those into chat. Otherwise, we'll wrap up here in the next couple of minutes.
Yeah, there's one question here. Oh.
Let's do our summary, and then we'll do our questions.
Yeah, so incredible quarter. We did our official launch of the Secure Freedom Fund. We bought Boulder Ridge Townhomes and Meadow Park Apartments. Technically Meadow Park's in Q2, but right on the border there. Staggering rent growth and vacancy declines that add up to a delta in portfolio value of like $10 million. So just incredible success there, and starting to shift back into a season of doing lots of renovations. Very excited to start, adding massive value in that way again. And then May 12th, we've got our next opportunity, our next launch for Secure Freedom Fund. Go to securefreedomfund.com and put your name on the wait list if you're interested in investing, or you can book a time on Elaine and I's calendar at securefreedomfund.com. So we look forward to seeing you then. Our last round filled in just a couple of days from existing investors and investors on the wait list. So please make sure to get on the wait list if you would like to invest. And then finally, Real Estate Real Life coming up this September 11 to 14. You can go to RERL2025.com and sign up. We will be there. If you want to use the Black Swan code, you save $300 on registration. So an incredible value there. We do not make money on this conference. This is a value that we put out for our investors, and we would love to serve you. We'd love to give you the opportunity to come see the assets that you own, or if you're thinking about an investment, all the referrals you could ask for are in that room. You can meet our property managers, our leasing agents, everything at Real Estate Real Life.
Super fun event. We would love to see you either here in person or join us virtually. That is a wrap on our Q1 2025 update. We have a couple of questions here that we'll answer. And then if you have any questions, pop those into chat and we'll get to those. A question that came kind of earlier in the presentation, how has your approach to renovation finishes changed in the current market?
Yeah, so we have multiple projects where we've done like huge renovations. We have a tendency to go fast and to go big, and it's a little overwhelming to municipal governments. So in a lot of ways, we've dialed back our scope of work. So instead of doing like quartz countertops, we might do laminate countertops. We still do, premium new cabinetry. We're not going to, refinish existing cabinets or reface existing cabinets. So still bring value any way we can. In Tacoma, we had like almost a year of time lost on Tanara Villa because we encountered so much regulatory red tape. We had similar issues in Rochester with City Hall, for example, or Dakota Townhomes. We retrofitted washer dryer units, which is often, it seems like, a pain point for some reason. And they're like, oh, well, you pulled a permit for the HVAC and the plumbing, but not the electrical. Or we install high efficiency washer dryer units that don't need ventilation ducting. And they'll tell us, well, we need to pull an HVAC permit and do ventilation ducting when there's literally no ventilation duct to hook up to. So it's kind of crazy, but that we bump up against that often. So before we bought Meadow Park Apartments, for example, we literally met with the head of building safety and the head of community development and said, hey, we're going to buy this community. We're going to do a huge turnaround effort. What would you like to see? If we do this, are you going to, if we update the sockets, are you going to require us to update all the panels? If we update the switches, are you going to require us to update the panels? Are you going to require us to do arc fault, ground fault breakers? If we update the panels, is that going to require us to do new mains and stuff like that? Because a lot of times, it's the cost of updating the socket or the switch isn't that bad. It's the upcoding and escalation that goes with it. Okay, if we replace, this appliance, are you going to require us to duct new ventilation ducting for the range, even though it's not a gas range? Lots of just crazy things that have been required of us by municipalities when they come and they see these huge value adds that we do. So we're literally, we got bullet point, we're going to do this and you're not going to require us to do this. We're going to do this and you're not going to require us to do this. And then we are kind of hounding them to bring out inspectors as often as possible, which might sound a little counterintuitive. But what happens is if we go with the usual milestone events for inspections, they come out and so much has changed so quickly. I mean, we might have like literally 50 people working on a job site. We're trying to go as fast as we possibly can because time is money here. And the inspector is overwhelmed and they give us a stop work order and they tell all those 50 people to go home for no reason other than there's just so much going on that they're not sure what to make of it. So it's been for a while. We basically just kind of shut down that deep value add part of our pipeline because we're bumping up. I mean, at Tanara, it's probably cost us millions of dollars that slowdown there, and millions of dollars across multiple properties here in Rochester. And I'm hoping we're past that. I'm really excited about what we're seeing so far in different properties that we're trying here in Rochester and in Tacoma. Or even in Austin where Northern Place Apartments is. Like the rental inspector there is an electrical inspector. So we can't do anything. We can't even update a light fixture without like a full permit, building permit, electrical permit, anything, because it's a small town and just that's just how it is. And so we just accept that and move on.
One of the questions is how much new multifamily supply is scheduled to hit the Rochester market in 25, 26?
This is kind of an interesting situation, and this is a situation that it's this way everywhere nationally. So, for example, there's a development, Bakery Flats, in Rochester. You can go Google it, and they demolished the old building. It's in a prime downtown, like urban core location. There's construction fencing up. They had to do all sorts of environmental remediation. I mean, they spent millions and millions of dollars buying and redeveloping the site, and then they stopped because this thing was supposed to go vertical about 18 months ago. It's just been a job site, a permitted job site that's been stalled out now for 18 months. And this is the case all over the country. A lot of people are saying, oh, well, all these deliveries are scheduled. But if you go visit the job sites, there's a lot of idle job sites out there. It used to be you could build something in a year or two. I bet there's a lot of projects that take 3, 4, 5 years to deliver because of all the headwinds that these developers are seeing. So right this second, Rochester is expected to see pretty steady deliveries because it's just such a great market, such a high value market. In the state of Minnesota, we've kicked out a pretty consistent number of units every single year for the last decade statewide. For 2025 deliveries, we're about 12% behind that rolling 10-year average. For 2026 deliveries, we're about 87% behind where we would be on a rolling 87% fewer units expected to deliver in 2026. And that's going off of current permits. So that includes that Bakery Flats project as a delivery for 2025 or 2026 because there's an open active building permit for it. So my belief is that it's actually going to be quite a bit worse than that. I think there's going to be a 95% decline in deliveries in Minnesota. And I think that's going to be the case most places in the country. Phoenix, Austin are just, I think Austin is like negative 12% annual rent growth right now. Like anyone in Austin is getting just eviscerated right now. Phoenix, I think, is like negative 8% annual rent growth right now because of all the deliveries that have come. Anyone that can pause their new development, they're going to do it. They're not going to like cancel their permit because they spent millions of dollars getting that permit, but they're going to do whatever they can to just kind of kick the can down the road. We know a developer in Tennessee, and they have over 1,000 permitted units, and they're just kind of sitting on them because they know that they're extremely valuable. They're just going to sit on them as long as they can. So, kind of a long answer to your question, but it's something that we will follow very closely because it has a huge impact on our business, and it's something that we do new construction, so it's something that we like to do.
I feel like I'm on a date because this is all we talk about when we go out on dates together. I'll just let you answer the next couple questions too.
Sure.
Do you need a cash out refi for return of capital to occur in Fund 3 and 4?
Yeah. So Fund 3 and 4. So the short answer is the Fund 3 and 4 will be higher cash flow vehicles than Funds 1 and 2, just because of the nature of the deals and stuff like that we got. We do need a cash out refi to achieve a full return of capital, but we'll be able to achieve a greater return of capital on cash flow alone in Fund 3 and Fund 4 because of just the nature of the deals in that fund. Yep.
And then why the Secure Freedom Fund instead of Fund 5?
Yeah, great question. So here's a perfect example of that. The legacy funds were predicated on a very specific set of kind of assumptions, business model, and our overall like strategy has not really ever changed. Like we buy high quality real estate in a good location, and we wait and we do cash out refinances, but our tactics, they change all the time. And we've always offered these different 10% fixed rate of return vehicles. It was actually the very first way that we raised capital on a couple of single family homes in 2018. And we've done joint venture partnerships and promissory notes. And so we've actually raised millions and millions of dollars of capital over the years in that 10% fixed format. We've just never done a Reg D 506C that we could publicly advertise before. So the Secure Freedom Fund is new in that we can go talk about it on a webinar and stuff. The biggest thing is that we saw a huge shift in investor demand. So when the market was going crazy and everyone was super excited to invest in multifamily real estate, everyone wanted a piece of the upside, so to speak. And now, as a lot of other operators have lost investor capital doing capital calls, people just want certainty. And so we're seeing a somewhat overwhelming amount of demand for that 10% fixed rate of return. And that actually lines up pretty well with the market conditions. So for example, there's an asset we're looking at purchasing right now. And the previous owner bought this asset for, I think, 11 or 12 million or something like that in 2021. And they're coming up against their loan maturity. They have to sell this asset. And we're currently offering, I think, like $7.8 million. I mean, they're going to lose millions of dollars on this thing. And we're buying that with a lower LTV loan. We'd be looking at like a Fannie Freddie loan. What's that asset worth a few years from now, 5 years from now? I really can't tell you. Like, it's already lost millions of dollars of value. I hope it's going to come back. I'm not sure. I feel good about it, in the long term, 10, 15, 20 years. In the short term, I can be very confident that it will produce that 10% fixed rate of return. Anything beyond that, I don't know. So Elaine and I are kind of shouldering the risk here. Like we might end up working for free for 5 years on that particular deal. Like that market is in decline. Is it at bottom? I don't know. Maybe. You never want to front run it too much. I don't think we're doing that. As long as we can make the 10% payment, we're good. And we can ride out 5, 10, 15 years if we need to. So it's a great fit with investor sentiment, which investors really want that high fixed rate of return. And it's a great fit with the deals we're doing right now. Like Rainbow Plaza, it's got that soft pay second lien on it and stuff like that. So it's an interesting asset. And I couldn't tell you what that asset's going to be worth 5 or 10 years from now. But I can tell you that because of that interesting debt structure that we're inheriting, it's going to be able to pay that 10% rate of return. Beyond that, there's a lot of uncertainty in the market. So I feel really good about the portfolio that we hold right now. And I feel really good about the assets that we're buying in Secure Freedom Fund. But right now, acquiring assets in the structure for the legacy funds, like funds 1 through 4, it's not a very good fit for investor sentiment. And it's not a very good fit for where we see kind of long-term valuation projections. So hopefully that's a long-winded answer, but hopefully that answers your question well.
Fund 5 will come. People ask about that. It will come probably 2026, maybe early 2027. We'll see how things go, right?
Yep.
There is so much there's, more uncertainty in the broader economy than, really since like 2008, right? With tariffs and immigration and the Trump
Yeah.
administration and government cuts and, all sorts of things. So Fund 5 will come, right? Lots of people love our legacy model. They're invested in all four funds. So it will come, but for now, our focus is on the Secure Freedom Fund. Secure Freedom Fund is a $100 million fund. So we'll be working on that fund for the next several years.
I was going to say, we were talking about the Colby redevelopment. That asset could be a great fit for the legacy fund because it's not going to produce a lot of cash flow for several years, right? So we just have to tailor the vehicles that we offer to our investors with kind of market conditions. Now is not a great time to redevelop Colby. It will be sometime in the next few years, and Colby, for example, could be a great fit for legacy fund.
All excellent questions. It is a pleasure to serve you. Thank you to all of you that have invested with us over the years. We hope you've enjoyed this performance update. Thank you to those of you who are considering investing with us and are using this as a piece of your due diligence. We look forward to our next launch of the Secure Freedom Fund on Monday, May 12th at 7 p.m. Central. That will be our live webinar. The replay will go out the next day as well. All of the information is available at securefreedomfund.com. You can take a look at the prior webinar that we did, review the paperwork, block a time on our calendar, basically get everything ready so that when we open it, if you'd like to invest, you've already made that decision and you can move quickly. We're only raising about $3 million in this round, so I do anticipate it will fill pretty quickly, and we look forward to serving our existing investors in that fund by having an opportunity to increase your investment, those of you that are on the wait list, and those of you that join us live on our webinar on May 12th. As always, if you have any questions, feel free to email Nick or I, email Rachel. We're here to support you. The replay will go out shortly, probably tomorrow morning, because it's a long file and it takes time to update. And then one of the things I want to make sure you guys all know about is that all of the replays, not only do they go on YouTube, we send them out via email, but they're all at meetblackswan.com/performance, going all the way.
Blackswanteam.com/performance.
Yeah. Blackswanteam.com. Sorry, we have two websites that direct to the same place. Blackswanteam.com/performance. All of the performance updates are there going back years, both the videos themselves and the brochure format, because some people just want to get that kind of quick 10-minute look at the brochure format. So all of that is there that you can review years of data there. It's been a pleasure to be with you today. Enjoy the rest of your day, everyone.
Thanks.
Bye.